Hey everyone, my name's Andy. My channel is Finding Value. What we're going to go over today is the commodity to S&P 500 ratio and how that lines up with all the other ratios to see if it's a good predictor of a price bottom or a price top. Because this will help us buy and sell assets if these things align pretty well. So let's take a look. Let's see how the commodity to S&P 500 ratio can predict other prices and ratios of other assets. So we're popping here. So it's commodity to S&P 500 ratio. Can we use it to predict prices? And the comparison here is I'm going to compare the commodities to S&P 500 ratio and use this as a buy trigger point. I'm also going to correlate the tops of this ratio for selling points. So does this ratio give us a good indicator of timing the purchases and sell points for commodities and the producers of those commodities? So this is the commodity to S&P 500 ratio. The green bubbles at the bottom indicate bottoms and the reds indicate tops. And I'm going to overlay these on a bunch of other charts, the timing of this, to see how well it lines up and to see if we can see any correlations with other things in this world. So the first thing I did is I overlaid it with the housing starts. The housing starts, so typically house prices go up, and when house prices go up, housing starts go up. What I have in here is a red line. That is the yearly demand for housing starts. And what you see here is the commodity bull market always lines up when we have I'll call it a housing shortage or deficit, or when a demographic, a larger population comes in to buy and the housing starts really start to take off in what we call a large expansion phase. An expansion phase of real estate, the expansion of new homes being built is what I'm talking about. So what we see is I overlaid this, and the green is when you want to buy, and we always go into a housing expansion phase, a very large one, and then usually it's a commodities top. Again, it happened this happened in a little bit after the 70s, all the way to the mid 70s. Then we've got one in the late 90s, all the way to 2008. And now we're doing the same thing, and the housing starts are about to come up and over the new housing demand of 1.5 million. So we're going to enter an expansion phase here shortly, which correlates with history. So this is just another way of saying that housing starts correlates with a commodities boom, which could be inflationary because each one of these is an inflationary period here. It was inflationary from 70 to 80. So we saw this big kind of cycle, and then it cycled back up and then peaked in 80. This was a very large demographic or population boom through here. This one was the loan debacle, where it artificially drove demand, but we also raised interest rates during this time period. We also have other correlations that I'll show you in other slides. So it correlates well with housing starts. Again, this is the uranium to, I'm going to go through ratios first. This is uranium to gold ratio. And if you notice, we would have bought in here and then rode the ratio down and sold where it's red. So it works very well in this scenario right here in this boom. Works decently okay on timing here. And right now we are in no man's land, so cheap, uranium to gold, that it is a ridiculous 62-to-1 ratio. It's screaming a buy, and I'm willing to bet that this is going to be a good purchase for a very long-term hold. Next, we do a platinum to gold ratio, and the green doesn't correlate as well with this one coming down, but it correlates very well with this one here. That would have been a pretty good timing, and it's correlating extremely well today. So we got 2 out of 3, I think, will work pretty well here. This is gold to oil. So this means oil is cheap at the top, oil is expensive on the bottom. Would have been a perfect time here, would have been a perfect time here. And right now we're up in no man's land, and I bet you it's going to be an absolutely great time to purchase. I think it's going to line up very well. So I would be looking into oil. Next, this is price. and I overlaid it with gold price. And what it shows is that the commodity bull market really fires up in the beginning of a bull market of gold. So it's here, here, and it looks like we're going to start another bull market in gold again. So if you look at these ratios and line them up to gold price, it's saying that we're going to have a gold bull run very shortly. So this thing's probably just going to launch. And that's my guess. It's probably correct. It just takes time. This stuff isn't overnight. It takes weeks, months, and years. Here's those overlaid on the price of silver. And again, it's very similar to gold. It's a very good indicator to buy. Very good. And then selling, you want to hold on to it. And it's roughly 3 years after. For both of these charts, 3 years after, 3 years after, and then when the red signifies we have 3 years after to hold on to gold. So this is giving a very good selling point for all this. And it's, again, this is 3 years after. This is 08, and you would have sold at 2011 top. So those are some indicators that I'm seeing of how to overlay this stuff. Next is the platinum price. And the platinum price here, it would have been a good indicator to buy, but it would have been a bad indicator to sell, and you would have wanted to held 3 years later. This one, it would have been a good indicator to sell because it was overpriced. Now this was a very, very big move. And again, it's showing to buy. So this would have been a good buy point, this would have been a good buy point, and this is a good buy point, I think. So the buy points are all very laid out and pretty straightforward for us. Now I overlaid it with uranium price. Great buy point for the uranium price here. Another really good buy point for uranium. Granted, you would have had to hold for maybe 3-4 years after this. Came all the way up, and it was a little bit after the peak here. So it still would have been a good buy point. It just, you would have had a little bit of lag. This one was almost nuts on. And this one, we don't know, but I'd be a buyer. Maybe we have to wait a year or two before this thing really gets cooking. Although it is there, the signal is there, it is bottoming, it is cheap, and it's signaling that we should be buying and accumulating these assets. They're all of these ratios. Here is oil price. So it was a nuts on for the buy point, a little bit off on the sell. The sell would have been better if you would have followed gold or silver. Nuts on for the buy point and nuts on for the sell point. And again, nuts on, I think, for the buy point down here. So it's flashing buy points. So I would be a buyer in oil. So a conclusion here, it looks like it's a pretty good predictor of price. The precious metals seem to extend past the commodity to S&P 500 ratio for about 3 years. The ratio is a great indicator for all the commodities that I can tell to buy. All those green circles, outside of maybe one time of uranium, they looked exceptionally good entry points. And we're flashing green right now, which means that platinum, silver, oil, natural gas, uranium, they're all flashing buy points. So what do we need to do? What do we have to prep? What you need to do is start watching my videos, see what I like. Look in the description of this video to see my natural gas holdings, to see my oil holdings, to see what uranium mining companies I recommend, and also to see the precious metals mining companies and royalty companies that I'm invested in and that I recommend. Keep in mind that these are at very low valuations. They are extremely undervalued. Extreme. At extreme valuations, you're going to see volatility and you're going to see some bankruptcies. So what I want you to do is you want to spread that money out. Spread it out amongst a bunch. Don't get all of your money in one where you get caught in a bankruptcy or some problem or they keep diluting shares. You got to spread it out. You got to reduce your risk by your betting strategy. Some of these that you're going to be in, you're going to be in for a while. It's not a year, it's not a 2 year. We're playing the long game here. We're going for the 8 or 15 year hold where we are going to reap massive rewards, massive moves to the upside. 10,000%, 20,000%. Big moves are coming, but you're going to have to be patient. This is a bottoming process. We are still early in some of these assets. Some are going to take off before others. SM Energy kind of already took off. We've got some other ones that are setting up that look very good. And spread the money out. Do not get caught with a bunch of money in any single one. That is my recommendation. If you like this content, please subscribe. Leave some comments if you have some questions. And click the thumbs up button to help me out. Appreciate it. Thank you. This is Finding Value.